Welcome to Business with Louis, the show where we dive into the world of entrepreneurship and explore the concepts that can help you succeed. Today, we're going to talk about understanding market corrections versus crashes. This is a crucial topic for anyone looking to navigate the ups and downs of the market and make informed decisions. So, what exactly are market corrections and crashes? In simple terms, a market correction is a decline in the value of a particular asset or market index by 10% to 20%. It's like a speed bump on the road to growth. On the other hand, a crash is a more significant decline, often exceeding 20%, which can be devastating for investors. To understand why these concepts are important, let's take a brief look at history. The stock market has experienced numerous corrections and crashes over the years, with some of the most notable ones being the Great Depression, the 1987 Black Monday, and the 2008 financial crisis. These events have taught us that markets can be unpredictable and that it's essential to be prepared for any scenario. One key concept is the idea of mean reversion, which suggests that asset prices will eventually return to their historical means. This means that if a stock or market index has experienced a significant increase in value, it may be due for a correction. Another important theory is the concept of behavioral finance, which studies how psychological and emotional factors influence investment decisions. For example, during a bull market, investors may become overly optimistic and take on excessive risk, leading to a correction when reality sets in. Influential thinkers like Warren Buffett and Benjamin Graham have also weighed in on this topic. They emphasize the importance of fundamental analysis, diversification, and a long-term perspective when navigating market volatility. Let's look at some real-world examples that demonstrate these concepts in action. Take the case of Amazon, which experienced a significant correction in 2018 due to concerns over its valuation and profitability. However, the company's strong fundamentals and growth prospects allowed it to recover and continue its upward trajectory. On the other hand, the story of Enron serves as a cautionary tale about the dangers of excessive speculation and complacency. The energy company's collapse in 2001 was a classic example of a market crash, where investors were caught off guard by the sudden revelation of accounting irregularities and corporate malfeasance. So, what can you do to apply these concepts in your own business or investment ventures? First and foremost, it's essential to maintain a long-term perspective and avoid making emotional decisions based on short-term market fluctuations. Diversification is also key, as spreading your investments across different asset classes can help mitigate risk during corrections. When navigating a correction or crash, consider the following tips. Take a step back and assess your overall portfolio, rebalance your assets if necessary, and look for opportunities to buy quality stocks or assets at discounted prices. Remember, every downturn presents a chance to acquire valuable assets at bargain prices, setting you up for potential long-term gains. It's also crucial to understand the role of monetary policy in shaping market outcomes. Central banks like the Federal Reserve play a critical role in stabilizing financial markets during times of stress, and their actions can have significant implications for investors. Research has shown that market corrections and crashes often follow periods of excessive speculation or complacency. This highlights the importance of maintaining a disciplined investment approach, avoiding herd mentality, and staying focused on fundamental analysis. Additionally, concepts like technical analysis and risk management can also be useful tools in navigating market volatility. Technical analysis involves studying charts and patterns to identify trends and potential trading opportunities, while risk management involves strategies like hedging and diversification to minimize losses during downturns. In conclusion, understanding market corrections versus crashes is a critical concept for anyone looking to succeed in business or investing. By grasping the key principles, theories, and real-world examples, you'll be better equipped to navigate the ups and downs of the market and make informed decisions. Remember, every great business starts with action, And by applying the insights from today's episode, you can set yourself up for long-term success. That's it for today's Business with Louis. Be sure to like, share, and subscribe, and remember, every great business starts with action. Make your next move count.